Hello guys, welcome to lecture number 2 of this chapter, and in this video we'll be trying to cover the remaining part of this chapter. This is your financial management tutor Uzair Awan, and let's just start right away. Now what we have already discussed in our previous lecture was how to value a business based on its asset, which is called the asset based valuation, which is our first category, right? And in that we discussed the net book value method, the realizable value method, and the replacement cost method. Then we discuss about how to value a business based on its income or its earning by using the PE ratio or the earning yields, right? So that is the second category that we discussed. And then the third category that we discussed was the cash flow based valuation. And in that we discussed that how do you value a business based on its cash flow from the ordinary shares using the dividend valuation method, right? Now we are going to cover the remaining part with the theoretical area and try to complete the chapter in today's video. So these are all the things that we have already discussed in lecture number 1, and that lecture number 1 has been uploaded on my YouTube channel. Okay, so let's start from here. Now we have the discounted cash flows. Now in discounted cash flow basis, it says that a business can be viewed as a combination of underlying projects. Just as the value of an individual project equals the present value of its future cash flow, the total value of the business should also equal the present value of the company's cash flow. So this discounted cash flow basis revolves around the logic that the total value of the business should always be equal to the present value of all the company's cash flow. So whatever the company's cash flows are, right, you just discount them to convert them into their present values, and then that's what you take as the total value of the business. Okay, so for a business valuation, as for project valuation, the relevant cash flows are the future operating cash flows, and the appropriate discount rate is the WACC that you guys would have studied in chapter number 11. Then it says the present value of operating cash flow provides a valuation of the company's asset. The value of equity can be calculated as value of assets minus the value of debt, something you guys already know. Okay, going forward, this is an activity number 5 that we need to cover. So you can see over here they have given you some years for the company, and they have given you the company's operating cash flows. Okay, then it says that the company plans to dispose of Juicy's asset at the end of 4th year for an estimated $230 million. Juicy has $15 million share capital with a nominal value of 0.50 a share and $50 million loan note in issue. Empire considers its current WACC of 10% appropriate as Juicy in the same business and relatively small compared with Empire. Required to calculate the value of value to Empire Company for each share of Juicy Company. So basically what's happening over here is that Empire Company is considering the acquisition of Juicy Company. The Juicy Company is another company, Empire Company is another company, and Empire Company is considering the acquisition. They are trying to acquire Juicy Company. Okay, and these operating cash flows that you are given, this is for Juicy Company. Okay, so, and these are post acquisition operating cash flows. Okay, and then they have given once you total these present values, that's how you get the total value of the assets, which are $211.1 million. Okay, so that's the total value of assets, because again, you in this question or in this area, we are assuming that whatever cash flow the company has, you just discount that and then you total those discounted cash flow, and that is the total value of the assets of the company. Now from this total value of assets from the company, you are going to subtract the $50 million, which is basically liability of the company, right? You're going to subtract this $50 million loan notes that you have in issue, because these are the liability of the company, right? From total assets, you are going to subtract the total liability, since $50 million is the only liability that the company has and no other liability. So 211.1 minus 50 million, that gives us an equity of 161.1 million. Okay, once we have our equity, then we are going to calculate the number of shares, and the way to calculate number of shares is that you take your total, $15 million, which is basically what, which is your total share capital. Okay, and you divide it by the nominal value per share, which is 0.50. Once you do that, you get 30 million as your number of shares. And once you have your number of share, you divide your equity with the number of shares to get your share price, right? You get your share price as $5.37. So this is how you calculate the share price or the value of the business using the discounted cash flow method. And it's very simple. It's very simple. Remember that in discounted cash flow method, you are assuming that the total value of the asset of the company is based on the cash flow that it generates from the asset. So whatever cash flow it generates, you just discount that based on their heirs, right? And you get the present value. Then you total the present value to get your total value of asset. You subtract total value of asset with the total liability to get the total equity, and then you divide the total equity with the number of shares to get your share price. That's how simple it is. So you guys can have a look at this, okay? And then we are going to move forward. So this method is the discounted cash flow method, okay? Now moving forward, we have some limitation for these methods. So it says that discounted cash flow methods are superior to non-discounted cash flow method in investment appraisal. As a model for valuation of share, it is considered the intrinsic value of a business based on its expected cash flow, future cash flows. Okay, so what are the weaknesses that this method has? Number one, estimation challenge, because again you are using the future cash flows, and future cash flows you will have to estimate. And whenever there's an estimation, I have told this in the previous lecture also, that estimation is a limitation in itself, right? So that's why that's the first weakness. The second weakness is the sensitivity to assumptions, which means that small changes in assumption about future cash flow and discount rate can lead to significantly different valuation. That is correct. For example, today I think that the future cash flow is going to be this much, and then tomorrow I think something else, or after 1 month I think about something else. I think that no, I think that now our future cash flow is going to look something like this, or our discount rates are going to look something like this. Then that's going to have a significant, variation on our valuation, right? So that means that it is sensitive to assumption. Okay, then the number third says that theory versus practice. A discounted cash flow based valuation is based on theoretically calculated intrinsic value. In practice, market prices can be influenced significantly by other factors, example the investors sentiment and the market trends. Okay, so yes, that's a very fair point. And then the fourth one says unpredictable cash flows. A discounted cash flow based valuation may be unsuitable for startups or high growth companies with unpredictable cash flows. So what they're trying to say is that this method only works for companies which have a constant or predictable cash flow, which is only in the case where they are big companies. But the companies which are small, which are startups, new companies, or which have high growth, right, for them, they do not have an predictable cash flow. Rather, they have an unpredictable cash flow because they are new company, they are startup, or they are growing very fast, right? So their cash flow keep on changing. So in that company, it becomes very harder to predict the cash flow, and therefore the cash flow becomes unpredictable. And since the cash flow become unpredictable, then you cannot use the discounted cash flow method. So these are few weaknesses or problem with the discounted cash flow method that you guys need to memorize. Okay. And now we are moving towards the preference shares. So if a company has issued preference shares, how is the company going to calculate the value of its share, or how are you going to value the company based on its preference shares? Okay, so let's read. It says that the market value of any share should equal the present value of the future dividend stream discounted at the investor's required return. As preference dividend are a fixed percentage of the share's nominal value, there would be zero growth of the future cash flow, and the share price becomes the present value of perpetuity. Now, if you guys remember that I told this in my previous classes, not in this lecture or the previous lecture, but in the previous classes, that there are two kind of preference shares. The first one is irredeemable, and the second one is the one that can be redeemed, which is called redeemable, right? Now, when we talk about redeemable preference share over there, the shareholder, they get dividend. Yes, they get dividend, and their amount can also be redeemed. They get dividend, and their amount after a few years can be redeemed, right? But in irredeemable preference share, I told you guys that the amount cannot be redeemed. The amount cannot be redeemed, but what the shareholders or the irredeemable shareholders get in return is a fixed dividend. right? So they always get a fixed dividend, just like you give a fixed amount of interest every year on your loan. Similarly, whenever you issue irredeemable preference share, you always give a fixed dividend to your irredeemable shareholder. Okay, so what a irredeemable preference shareholder get is a fixed dividend, remember that. Okay, and one thing that I told you guys also is that whenever the question tells you about preference share and it does not tell you that whether it's redeemable or irredeemable, then by default you are always going to take it as irredeemable. Okay, and this is a very good example. If you read over here, they have just said preference share, that's it. They are only talking about preference share. They did not tell you whether it's irredeemable or redeemable. But if you read over here, they're saying that the market value of any share should equal to the present value of the future dividend stream discounted at the investor required return, as preference dividend are a fixed percentage of the share nominal value. So preference dividend are a fixed percentage of the shares nominal value. That is only in the case of irredeemable preference share. So that means that this thing that I told you guys over here is correct. Then whenever they're talking about preference share and they're silent about whether it's irredeemable or redeemable, then you always take it as irredeemable. Okay, now whenever you have preference shares, you know that it's going to be irredeemable preference share, and the way that you calculate its market value is very simple, and that is that first of all you calculate the fixed dividend. How do you calculate the fixed dividend? Let's take activity number 6 as an example. So it says a company has in issue 5% preference share, each with a $1 nominal value. So you always multiply the percentage with the nominal value, which is $1. Okay, so if I multiply 5%, which is my rate of the preference share, with $1 nominal value, I'm going to get $0.05. Now this $0.05 is basically the annual fixed dividend. It is the annual fixed dividend. Okay, so that's how you get your annual fixed dividend. And then you look for your return on equity, which is 4.7%, which is already given to you over here. Okay, that's the required return rate. Okay, and once you have your dividend and your required return rate, you just divide these two. You just take your dividend and you divide it by the required return, which is 4.7%, which can be written as 0.047, right? So that's gonna be $1.06. That's my P naught, or my market value of the share. Okay, so you guys see that whenever you have preference share in issue and you want to calculate the market value of the share, that's how you do. It's very simple. It's very simple for preference shares. It's very simple. You calculate the dividend, and the way that you calculate the dividend is that you take the percentage and multiply it with the nominal value. That's a fixed thing. That's a thing that we always do, and you guys know that. You always take the percentage and multiply with the nominal value. You get your dividend, and once you have your dividend, just multiply it with the required return rate, which will always be given to you in the question, and that's how you get your P naught, or your market value for share, which is $1.06. Okay, so with this our preference share is also completed. Now we are going to look at the irredeemable loan notes. So irredeemable loan notes, now we have entered the area of loan notes. Okay, first of all, clear your mind that now we are not talking about the shares. Now we are not talking about the shares. We are talking about the loan notes, and loan notes can be irredeemable and they can be redeemable also. Okay, they can be irredeemable and they can be redeemable also. They can be irredeemable and they can be redeemable also. Okay, so same logic, that irredeemable cannot be redeemed, redeemable can be redeemed, right? And these are loan. Okay, remember that. So if you have a irredeemable loan note, it's going to be exactly the same as the preference share, because remember the preference share, I told you they are also irredeemable. So if preference shares are given to you, you just assume that they are irredeemable. And how did we do the calculation for irredeemable preference shares? That you just take the dividend and divide it by the required return. Similarly, you are going to do the same thing if you have the irredeemable loan note, and that is that you are going to calculate your interest, because this is loan, right? So you won't have the dividend. What you will have is the interest, and the interest is going to be calculated in the same way just like you calculated the dividend in the previous example. So 7% is your percentage of the loan note, and the nominal value is 100. So 7% of 100 is $7. That's my interest, right? And now I'm going to divide the interest with the yield, or you can say the return, which is 7.42%. So 7 divided by 7.42%. Okay, that's gonna give me $94.34. So you guys see how similar it is. You guys see how similar irredeemable loan note is with the preference share, right? both working are same. Okay, both workings are same, just that in the preference shares, since they are shares, you keep dividend in the numerator, right? And in the irredeemable loan note, since they are loan, you keep the interest in the numerator, right? So that's the only difference, except for that everything is same, right? Something that you guys need to focus a little bit on. So whenever you have redeemable loan notes which can be redeemed, how would you calculate the market value of the share? So now we are looking at redeemable loan note activity number 8. It says a company has an issue 8% $100 nominal value loan notes redeemable at 5% premium in 10 year. Okay, so it's redeemable at 5% premium in how many years? In 10 years. Okay, the bond yield to maturity is 10%. Okay, which means the required return. Okay, and you are required to calculate the market price of the loan note. Okay, now, so in order to calculate the market price of redeemable loan note, what we can do is that first of all, we are going to calculate our interest. Okay, now again, these working that I am doing over here, or we are looking over here, is not something new. You guys have seen this in previous chapter, because in cost of debt, you guys have already studied that how to calculate cost of debt using the redeemable loan note, right? So the working is going to be similar, but obviously there's going to be few more things. So first thing that we do is to calculate our annual coupon, and you guys know that you always take the percentage and times it by the nominal value to get your interest, right? So you got your interest as $8. Now as you guys know that this $8 interest is going to be constant, right? So what you're going to do is that you're going to multiply this $8 with the annuity factor, because it's going to be constant for the 10 years, because you're taking this loan note for 10 years. So $8, $8, $8 for the next 10 years, it's going to be constant, right? So that's exactly what we are going to do. We are going to basically, apply annuity factor of 10 years at 10%. Annuity factor of 10 years at 10%, because 10% is our yield to maturity or our return, right? Yield to maturity means return. Okay, so 10% for 10 years. So annuity factor, you guys can check this in the table, is 6.145. So if I times it with 8, I get the present value of my interest, which is 49.16. Okay, now we are going to calculate the redemption price. So redemption price, as you guys know, it's saying that it's going to be redeemed at 5% premium. So that means that if the nominal value is $100 and it's going to be redeemed at 5% premium, so that's going to be 105. That's going to be $105, right? So you can get $105 as your redemption price. And again, this redemption is going to be at the end of 10 years, right? So you have to use the 10-year discount factor at 10%, right, to calculate your present value of the redemption price, which is going to be 40.53. Okay, and then you are going to add this present value of redemption price with the present value of the interest to get your total present value, which is 89.69, and this total present value is going to be the market price of the loan note. Okay, so I hope this way of calculating market price of bond is clear to you guys. So in the case of redeemable loan note, this is how you calculate the market price of each bond. Okay, okay, now we'll be looking at convertible loan notes. So convertible loan notes, you guys know that it has an option that you can either convert it into shares at the end of the period of the loan note, or you can just keep it as loan, right? So it has this option that you can convert it into shares. That's why it's called a convertible loan notes. And you can see over here, it says convertible loan notes allows the investor to choose between redeeming the loan notes at some future date or converting them into a predetermined number of ordinary shares. To estimate the market value, it is necessary to predict whether the investor will choose redemption or conversion. That is correct. That if you want to actually calculate the market value of the loan note, if it's a convertible loan note, then first of all, you will have to study the option. You will have to check that what will investor go for. Will he go for the redemption, or will he go for the conversion? So first of all, that's the first thing you guys need to look at. Okay, and then there are a few new terminologies like the floor value, the conversion premium. So I'm going to explain them with the example. Okay, that's going to be much more easier for you guys to understand. Okay, so first thing first, we have this activity number 9, and in this we are going to calculate everything. Okay, so we are going to get the clear meaning of floor value and conversion premium from this. Okay, so first of all, let's just read the question. What does the question says? Activity number 9, The question says a company has 9% loan note in issue, redeemable at their nominal value of $100 in 5 years. Alternatively, each bond may be converted into 20 ordinary shares on that date. The current ordinary share price of 4.45 is expected to grow at an annual rate of 6.5% for the foreseeable future. The debt holder required return is 7% a year. You are required to calculate the following for each $100 convertible loan note: the market value. So first of all, forget about the floor value, forget about the conversion premium. We don't know what that is. We just have to learn how to calculate the market value of the convertible loan note. So first of all, we're just going to look at that, how to calculate the market value. Okay. So the way that you calculate the market value is, like I said, step number one, you study the option that are people going to go for the conversion? Are the investor going to go for the conversion, or are they going to go for the, the same loan note? Okay. So will they keep the same loan note, or are they going to go for the conversion? So that is something you guys need to first study. So for that, what we do is that we basically use a formula, right? And what we do is that we first of all check that, okay, what's the price is gonna be. So expected share price in 5 year time, that is something that we calculate. Okay, because obviously, what's the period of this convertible loan note? It's the, I think it's 5 years, right? Yes, in 5 years, right? So that's the period, 5 years. So after 5 years, the investor will have the option whether they need to convert or no, right? So after 5 years, I need the share price. I need to check that what's the share price after 5 years. So for that, I'm going to take the share price right now, which is 4.45. Okay. And what I'm going to do is that I'm going to times it by 1 plus growth. Okay. So I'm going to times it by 1 plus the growth. I'm going to times it by 1 plus the growth. So what's the growth that is expected? There is an expected growth at an annual rate of 6.5%. Okay. So I'm going to say that, okay, what is my share price gonna be after 5 years? So I take my share price, which is right now 4.45, times it by 1 plus growth, and then I'm going to take the power as 5 because I'm looking for 5 years, right? So that is exactly what they have done over here. 4.5 times 1 plus the growth rate, which becomes 1.065, and they have taken the power of 5. So you can see that we got the value of 6.10. So that's the value of share after 5 years. Okay. And then after 5 years, how many shares are we going to get as the part of conversion? 20 shares, right? So we can convert our loan into 20 shares. So I'm going to say that, okay, the share price after 5 years of one share is going to be 6.10, and I can take 20 shares. I can take 20 share as part of the convertible loan note. So that's going to be equivalent to $122. So that's the value that I will have in the company, $122. Okay. Now let's compare this with the redemption. That, okay, if I don't go for this conversion option, then what am I going to get in terms of redemption? So let's see what were they saying about the redemption. So they were saying that redeemable at their nominal value. So that means that the loan note is going to be redeemable at its nominal value of $100. That's it. Okay. So that means I'm going to get $100 after 5 years if I go for the redemption. And if I go for the conversion, then I'm going to get 122. So any rational investor will go for this option because obviously he's getting more return from it, right? So that is one thing that we looked at first. This is step number one. Remember that step number one, you always look at these two options, that which one is more beneficial for the investor. So whichever is more beneficial, that is the one that any rational investor will go for. So that means now we will have 122 at the end of 5 years. Okay. After we have decided this, now we are going to calculate the present value, because remember that this area revolves around the present values. So now we are going to calculate the present value of future interest payment first, because these are the two kind of cash flows, right? The first one in form of interest, and the second one in form of the shares or the loan. Okay, but in this case it's the share, since it is giving more return. So first thing first, we are going to discount our interest. So interest is 9, right? And how do I know it's 9? Because again, that you had 9% loan notes and the nominal value was $100. So 9% of $100 is 9, right? So $9 is my interest, and this 4.100 is basically the annuity factor. Value of shares that I'm going to get after 5 years, which is 122. Okay, and then you times it by the discount factor, obviously, right? This is the annuity factor because interest payments are same for each year, just like the way we did in previous questions, right? And this is discount factor because 122 is a one-off thing that you're going to get at the end of 5 years. So you multiply it with discount factor, right? And once you have done these, and once you have done this, then you have the present value, and you can then just add the present value to get your basically market value of the loan notes, right? So this is how you get your market value of a convertible loan note. This is how you can get the market value of a convertible loan note. Okay, now you have to calculate the floor value. Now you have to calculate the floor value. Now what is the floor value? Remember that floor value is very simple. In floor value, you are going to ignore this step number one. You are going to ignore this step number one, that whether the rational investor is going to go for, you know, the share conversion or the redemption. Which one will it go for? You ignore the step. Rather, you just assume this, that he is going to just go for the redemption. He is just going to go for the redemption. So if we go for the redemption, you can see the working is going to remain same. 9 times the annuity factor plus. Now instead of 122, you are just going to take 100, because in this floor value, we always assume that the investor is going to go for redemption, right? So 100 times the discount factor, and you get your value. So this is your floor value. That's how simple it is. Floor value is same. Everything is same. Just that in this, you just ignore this step number one, because you just assume on yourself that he is going to go for redemption. That's it. Okay. And the third thing that we have to learn is the conversion premium, which is also very simple. How do you calculate the conversion premium? That you first calculate the current conversion value. So you know that your one share was equal to 4.45, and how many shares are you going to get? 20 shares after 5 years. So that's $89 worth of shares today, right? This is the value today, that today my share price is 4.45, and I'm going to get 20 shares. So today it's going to be worth $89. But after 5 years, it's going to be equal to 123.89 that we have just calculated over here, right? So what I'm doing is that I'm saying that, okay, if I, calculate the conversion value after 5 years, we have already done that. It was coming to be 123.89. But what if I do it today? If I do it today, then that's worth $89. Worth $89. That's $189, right? So I just took my market price and times it by the number of shares that I was getting, 20 shares. So that's $89, right? So today it's worth $89, and after 5 years it's worth $123.89. So how much more am I getting after 5 years? That's my conversion premium, right? So for that, all you have to do is to subtract these two values, and you get 34.89. That's your conversion premium. And this whole working also makes sense, right? So you see, this is how you calculate your conversion premium, that you assume that, okay, what if I get the same shares today? That's $89. And after 5 years, it's going to be 123. So what's the premium? The premium is 34.89. Okay. And usually whenever the question asks you to calculate the conversion premium, you give it on a per share basis, which means that once you have your conversion premium 34.89 just divided by the number of share, which were 20, so you get 1.75 conversion premium per share. Okay, so usually you give your answer in terms of per share. That's exactly what they're saying over here. Okay, now I hope you guys have a clear idea how to calculate market value whenever you have a convertible loan note. You guys have a clear idea of what floor value and conversion premium means. Okay, now activity number 10, I'm going to leave this for you guys. It's the same as this one. Okay, just that over here they have given you in part number A 4% per year, in part number B 6% a year. So there is a difference in the share price increase or in the growth. Okay, so part number A, you're going to take the growth as 4%, and part number B, you're going to take the growth as 6%. That's it. Okay, so you can easily do that, nothing else. And with that, our calculation part is complete, and trust me, we have completed everything there was in the study hub chapter of business valuation. We have completed all the calculation. Right now we are going to look at the theory. So for theory, the first thing that is present over there is the reasons for business valuation. So the first point says that to determine the value of a private company, example for a management buyout MBO. MBO is basically management buyout where the management decides to, buy out the company. So if they want to, buy a company, or if you want to determine the value of a private company, how would you do that until you do the valuation of the business? Okay. It is because of the valuation of the business that you get to know that, okay, what's the maximum price that I, can go for, or what's the fair value that I should acquire this company for, right? So these 2 points says the same thing. The third one says to aid in decision on buying, selling shares in private companies. So yes, if you want to buy or sell shares in a private company, then it's going to help you in decision making if you have the proper valuation of the business. Okay. Then it says to value companies entering the stock market. Yes, if you want your company to be listed on the stock market, then you need the valuation of the business. You need to know what your business is worth. Only then you can, decide a fair price or a fair value to, give the companies which will help you to list on the IPO, initial public offering in the stock market, right? And that's what you're going to offer to your investors, whoever wish to invest in your company. Okay. And then it says to value subsidiaries division for possible disposal. Yes, if you want to, dispose of your subsidiaries, some of your divisions of the company, then you need a valuation to sell them, right? So again, all these points are pretty similar, and they all make sense that why a company needs to value a business. So you guys can just learn it. And then it says what is the type of information that is required to for a business valuation. So you need the financial statement of the companies. You need to go through the non-current asset summary, the summary of working capital, which includes inventory, debtors, creditors, right? Budgets and forecasts of the company, summaries of contracts such as leases, details about the shareholder and their shareholding, information about the industry and the broader economic environment. So these are all the documents, the all things that are necessary for you to go through in order to decide the valuation of a business. So these are the type of information that are needed for a business valuation. Okay. And they have said that these are not all of them. It's not limited to these. Okay. There are much more, but these are the few ones which are very important. Okay. Then we are going to discuss the nature of business valuation. So it says business valuation is a complex exercise. Yes. There is often no unique answer to the question of what a business is worth. Example, the value to the existing owner may be significantly different from the value to a potential buyer. So yes, they're saying that there is no exact science of how to calculate or how to value a business, because if I am a potential buyer, I might value a business based on several factors that we have discussed before, right? But if a owner is valuing his business, he's going to, value it from a different angle. So there's no exact science to reach the value of a business because it's a subjective matter. Okay. There are various methods of valuing businesses, as you guys already know now. After completing this entire chapter, now you guys know all the various methods of valuing businesses, which may produce different overall values. These can be used to determine a relevant range of prices between the minimum price the current owner is likely to accept and the maximum price of the bidder likely to pay. So that's exactly what they're saying, that yes, it's correct that you cannot, you do not have the exact science to reach the value of a business or to value of a business, but what you can do is by, the all the methods that we have discussed, you guys can, use or leverage those methods to reach that. Then we have the marketability and liquidability. So marketability, the unquoted company is less marketable. Why? Because they are not traded via the stock market. Okay. So this reduces their value relative to shares that are, listed on the stock market that are in quoted companies. Okay. Furthermore, unquoted companies are not required to comply with stock market listing rules or corporate governance code, increasing their perceived risk and further depressing their value. Yes, because an unquoted company, an unlisted company is not listed on the stock market, so it does not have to follow the stock market regulations, right? And stock market regulations are designed to regulate those companies who are, raising funds to the public. So they have to be very carefully regulated, right? And the companies also have to be very careful about everything they do, right? Then there is corporate governance code also that those companies are required to follow. But if a company is not listed on the stock market, then it does not have to follow the stock market regulation. It does not have to follow the corporate governance code, which basically increases the perceived risk that the investors perceive from that company, right? The investors perceive that there is going to be more risk in these type of company because there is no regulation on them, and therefore they can do whatever they like, right? Therefore it's very risky. It's much more risky to invest in unquoted company than in quoted company. Okay, so this is something that we have already discussed, and then they're saying that some analysts adjust the PE ratio of a comparable quoted company downwards by as much as 40% when valuing unquoted shares. So yes, that is something we have already looked at before, that we adjust our value that we get for PE ratio from quoted companies, and then we always reduce it by half, almost 50%. They are saying 40%, but we have learned that we always reduce it by 50% half, right? Almost by 50% half, so that we can just adjust for the risk and the marketability factor that we have just discussed in this paragraph, right? So that is something we have already discussed. And then we have information sources and availability. Potential investors generally have plenty of public available information when deciding whether to buy, sell quoted shares. Example, public accounts, earning forecasts, research reports, news and analysis in the financial press, and data services such as Bloomberg and Reuters. However, much less information may be available for unquoted companies because they may not be required to public accounts or have exemptions from producing group accounts or showing a statement of cash flow. So this is a very important point, that the listed companies, they are required to submit all their accounts and every data to the public because they are listed, right? So they should not hide anything from the public because they are raising fund from the public, so they should be accountable to the public, right? But the unlisted company has nothing. They are not required to publish their accounts. They have a lot of exemptions, so they are not required to do that because they are not raising fund from the public. They are not liable to the public, right? Therefore, since they have very little information available to the public, so if I am an investor, for example, and I want to invest in ABC company, and there is nothing available about that company in the public, so obviously I will be a little reluctant to invest in this company, right? So that's the point that they're trying to make. And then we have market imperfections and price anomalies. So they're saying, although the dividend valuation method gives an idea of the fundamental fair value of a share, it is based on perfect market assumption. Example, many buyer seller of the shares, zero transaction cost, freely available information, and rational investors. So you guys would know about this perfect market assumptions from the previous chapter. That perfect market assumption is that there are many buyers and sellers of the share, there's zero transaction cost, freely available information, and rational investors present everywhere, right? So that's what a perfect market looks like. But actually in real life, you don't have a perfect market, right? So yes, dividend valuation method is a very good fundamental way of finding the fair value of a share, but it is based on perfect market assumption, which is again just an assumption. Okay, because in real life you don't have perfect market always. Okay, so every major market such as the New York or London Stock Exchange are not perfect markets. See, as evidenced by the following, that irrational investor behavior. Example, they believe that recent price rises will lead to future prices rises. The over exuberance can lead to speculative bubbles. Example, the tech bubble in the 1990s. This is explored further in the behavioral finance that you will see in 5.5. Okay, so basically that's the main point, that even the New York or the London stock exchanges are not the perfect market, right? So this assumption is basically wrong. Now what is price anomalies? They're saying price anomalies which appear to contradict perfect markets. The January effect is where investors sell shares at the end of December to utilize any tax losses on them, then buy back the shares on the start of January. The overreaction effect is where the share prices appear to overreact to unexpectedly good or bad news initially, then slowly move back towards the fair fundamental value, right? So they're saying that these are all the effects. They're talking about the different effects that people follow, like the January effect. They sell in December and then buy again in January just to avoid tax payments. Okay, then there's an overreaction effect where if there is a bad news, then a lot of people will start to sell the shares and the share price will come down, and then after a few months it's just going to come back to its fundamental value. Similarly, if there's a good value, the share price is going to shoot, and then after a few months it's going to come back to the fundamental value. Why? Because there's an overreaction from the market that, oh, if there's a good news, everyone starts to buy, or oh, if there's a bad news, everyone starts to sell, right? So it's based on the overall overreaction effect. So these are all the effects that are there in the market, and that is what the pricing anomalies is basically, that it contradicts the perfect market, because again it is against the idea of the perfect market, that where all the investors are rational, There are many buyers and sellers of the share, zero transaction cost, freely available information, right? So pricing anomalies is basically, it basically contradicts perfect market, because you can see that these examples that we have discussed are not of a perfect market, right? These are pricing anomalies. Okay, now we have market capitalization. So you guys know that market capitalization refers to the total market value of a quoted company. So number of issued ordinary shares times the market price per share, and you will have your market capitalization, and you guys can give it a plain read because there's nothing very important in this. Okay, now we have behavioral finance that we need to discuss. So it says speculation by investors is a significant factor in the behavior of share prices. Behavioral finance is an alternative view to the efficient market hypothesis and attempts to explain how managers make financial decisions in real life, why their decision might not appear rational and have unpredictable consequences, right? So speculation by investors is a significant factor in the behavior of share price. Yes, this contrasts many traditional theories which assume investors make rational decisions. So just like we were, trying to understand the meaning of a perfect market where the investors are rational. So that's what they're saying, that this contrasts many traditional theories which assume investors make rational decisions, while in fact in real life they do not. Okay. The market paradox is that investor must believe that they are inefficient for market to be efficient, right? So that's a paradox, that investor must believe that they are inefficient for the market to be efficient. If they thought them to be efficient, they would not buy or sell shares, thereby slowing the dissemination of information into the market prices. You see? So this is a very good point. Now we have different types of mentality of investors, right? So that's what we are going to look at. The first one is the herding or herd mentality, where what happened is that the desire to conform and not to act differently from others. So that's what herd means, right? Herd, that you follow herd, you follow a group of people, whatever they are doing, you're going to do that. Okay, so if they say that sell this share is going to go down, you sell it. If they say that buy this share is going to go up, you buy it, because you're following the herd. You're following the herd. You do not have your own understanding or your own analysis about the market or about the share. Okay, so individual investor lacking confidence believe that a large group of other investors cannot be wrong, right? So any individual investor who does not have understanding of the market, who lacks confidence, he just blindly believe a large group of other investors who he thinks are very very well aware, and they can never be wrong, and their estimates or their assumptions or their whatever predictions of the market are absolutely correct, and they just follow them. So this is what the herd mentality is. Okay, if many investors follow a herd instinct to buy shares in a specified sector, a significant price rise for share in that sector can lead to stock market bubble. Yes, obviously, if for example I buy shares based on the herd mentality by looking at some other people or some other investors, right? And in the same way, there are some other people also who follow those investors who we think are very very well aware of the market, and they also buy the shares. Obviously, when everyone is going to buy those shares because someone is saying, and they follow the herd mentality, then the share price will go up, right? Then we have the second type. So the first one is what we call the herding or the herd mentality. The second one is what we call the noise traders. So noise traders are investors who do not base buy sell decisions on rational analysis without using fundamental data about the company's performance. Noise traders generally have poor timing, follow trends, and overreact to good and bad news. So these are the noise traders who follow the noise, who follow the noise. So whenever there's a noise in the market that something bad is about to happen, they sell the shares. And whenever there's a noise in the market that something good is about to happen, they buy the shares. Okay, so that's why they are called the noise trader, right? Because they do not buy or sell shares based on rational analysis, like for example using fundamental analysis or technical analysis. They do not do that because they do not know how to do that. All they do is just to follow the noise. Whatever the noise say, they're going to do that. Okay, so these are noise traders. So noise trader basically avoid investments with the risk of making losses, even though expected value analysis suggests that in the long term they will make significant capital gains. So they're saying that these noise traders, they have a habit that even though value analysis would say, for example, that if you invest in this particular stock, you will have a long term significant capital gain, but they will not do that. Why? because they have a risk of making losses, so they are afraid, they do not take the risk of making losses. So this is one, you know, thing about the noise trader. Then it says that they prefer to invest in companies that look likely to make stable but low profits rather than those that may generate higher profit in some year but possibly losses in others, right? So that means that they are not risk taker. Simply that means that they are not risk taker. Then we have our third kind of investor, which are the overconfident investors, which tend to hold a false or misleading assessment of their skills, intellect, or ability. In other words, a belief that they are better and more able than they are, right? That's why they are called the overconfident investors, because they believe that, oh, we know everything, the others do not. So we are better than the others. So this excessive confidence that they have can cause the investor to be reckless and make mistakes. Yes, right? Then it says that an investor who believes their action will directly affect the stock market and they have a certain degree of control of the market has an illusion of control. A bias towards optimism often leads investors to have an unrealistically confident view of themselves and their futures. Investors exhibit confirmation bias if they only seek information that goes against my belief. I'm going to ignore that. Okay, I'm just going to look for information that support my belief. That is called the confirmation bias, right? And any investor which exhibit confirmation bias always seek information that support their belief. This bias may lead them to focus only on information reinforcing their opinion about investment, right? Selectively choosing which information to use can lead to a lack of diversification. Yes, therefore, individual may not make decision based on a rational analysis of all available information, which they should, but they would not. Why? Because they are overconfident, they have a confirmation bias. Okay. This could lead to prices for an individual company and the market being valued either very high or very low. Okay. And with that, the theoretical area of this chapter is also complete, and this entire chapter is complete. Okay. So if I go back to the business valuation summary, you can see that we have covered the asset based valuation, the income or earning based valuation, the preference share based valuation, and then the cash flow based valuation, in which we covered the dividend valuation method. And for debt, we covered the irredeemable debt, the redeemable debt, and the convertible debt, right? So everything is covered, everything is done. And I hope that this video was also helpful for you. So in total, we have two videos in which we have covered this entire chapter. If you guys like this video, if this video was helpful for you guys in any way, please support me by liking and subscribing this channel, and sharing this channel with your friends, with anyone who is doing ACCA, or who needs to understand this chapter. Please share this with them and subscribe this channel. And if you guys have any query, you can comment in the comment section, or you can see the WhatsApp number on the screen. You can always message me directly and I will respond to your queries, any queries that you might have, as soon as possible. All right, so I'm gonna meet you guys in the next video with a new chapter. Till then, take care, have a great day, goodbye.